Okay, great. We are going to get started. Thank you everyone for joining us today. My name is Rob Livson. We're very happy to present the tips for traders on preparing 2018 tax returns with Robert Green and greentradertax.com. Before we get started, I'm just going to do a brief disclosure for our compliance. So just hold on 1 minute for us here. Please note this presentation is for informational purposes only. Nothing presented today should be construed as investment advice or recommendation to buy, sell, or hold any security or contract. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Security, derivative, and futures trading involves substantial risk of loss and is not suitable for all investors. Each investor must consider whether this is suitable investment, since you may lose all or more than your initial investment. Past performance is not indicative of future results. Lightspeed is a division of Line Brokerage LLC. Line Brokerage LLC is not affiliated with these third-party market commentators, educators, or service providers. Data, information, and material content provided for informational, educational purpose only. This content neither is nor should be construed as an offer, solicitation, or recommendation to buy or sell any securities or contracts. Everything is independent analysis and consideration with your own financial circumstances, objectives, risk tolerance. Great, thank you. So we are happy to present here. Anyone for more information or a demo of our software, feel free to contact me, Rob Livson, rlivson@linebrokerage.com. We are happy to present the tax presentation here for 2018 tax year. It is one of our most popular webinars. Everyone looks forward to it. We're happy to have Robert Green, CPA and founder, CEO of Green & Company, greentradertax.com, publishing company, managing member and founder of Green, Neuschwander Manning, LLC, tax and accounting firm catering to traders, investment managers, small business. He's one of the leading authorities on trader tax, and he's contributed to Forbes. You've seen him on CNBC, Bloomberg, Forbes.com, has appeared in New York Times, Wall Street Journal, Forbes, Barron's. He's one of the experts on any changes in tax laws, specifically for trader tax, chief presentator here today. So we're so happy to have him come back and provide us with some information, and hopefully you guys will really be able to take some advice here from the expert and learn how to properly manage and prepare your tax return. So we are very happy to have Robert here. I'm going to make him the presenter and we will get started right away here. So guys, here we go. Thank you. Robert, you should be able to share the screen.
Thank you, Rob, very much. Let me just minimize and start the presentation. I'm joined today by my co-managing member, Darren Neuschwander, and other partner, Adam Manning. They're the co-experts. We're going to talk about tips for traders, and most of you are traders, you're active, on preparing your 2018 tax returns. Deadlines are coming up, March 15th for partnerships and S-Corps, April 15th for individuals. This is from Green Trader Tax. March 6th is good timing. I'm a managing member of Green, Neuschwander Manning, LLC. That's our CPA firm. And I'm joined by Darren Neuschwander, who's head of tax compliance, and Adam Manning, who goes along with Darren as the director of tax compliance. They run that part of our business. That's our core business. They're the guys you want to talk to. They're here today to talk to them, to ask questions on the board. While I'm talking, Darren's going to be answering your questions, so text them in, short and sweet. We're a CPA firm dedicated to the needs of investors, traders, investment managers. We talk about trader tax status, 475, all the benefits for traders, which is, it's almost a reverse world to other types of taxpayers. You know that when you go to see a local CPA, they may not know trader tax. Our focus is tax compliance, accounting, consultations, entity formations, and IRS and state controversy. We're a virtual firm. This is educational. It's not individualized tax, legal, or investment planning advice. If you need that type of advice, get it from us in a consultation. I do those personally. I do the consultations. So me, Robert Green, Darren Neuschwander, Adam Manning, we are not affiliated with Lightspeed. We're a CPA firm. They're a brokerage firm. Today, we're going to talk about several new and revised tax forms. There was that major new tax law, the 2017 Tax Cuts and Jobs Act. all the proposed regulations, new forms, instructions, draft mode, final form. And Darren every day is finding inconsistencies along with his other members of the AICPA task force on that. And they're constantly contacting the IRS saying, what about this inconsistency or that one? And stuff falls through the cracks. So this is not a year you want to rush. You want to learn how traders eligible for trader tax status get the golden goose. They maximize the business expenses, the home office deductions, the startup expenses, using critical tax reporting strategies. Because guess what? Investors always got the shaft. They got puny deductibility, but they got something. Now with the new tax law, they get next to nothing. The only thing left for investors are stock borrow fees and margin interest. Your investment fees and expenses, all those deductions you have as a trader are suspended. You need trader tax status more than ever, and the good news is you can still claim it. You didn't have to elect it. Now, don't take your 1099B as dictate what you have to do. Don't just import it to your tax returns. There might be opportunities to switch. They may call something a security. When we say no, that's a 1256 contract with 60/40 capital gains rates, almost 1/3 off the capital gains rates. An example of that would be a CBOE listed option on a volatility ETN. We think it's 1256, but your 1099B may say it's a security. There may be opportunities to use 475 ordinary loss treatment if you elected it on time, instead of having those crazy wash sale loss adjustments. We're going to talk about that. Now, maybe you missed a 475 election or an S-Corp election for 2018 and you're sorry you did. But don't put your head in the sand. Maybe you need to make that election for 2019, but you may have tax baggage. We're going to talk about that. That deadline is March 15th for 475 for S-Corps and partnerships, April 15th for individuals. So we're kind of up against the partnership and S-Corp deadline. Don't panic. There's time to do the right thing. It's a simple extension. And there's time for April 15th. If you want to work with us, you got to get started right away. Now, we're going to talk about common errors on tax returns for traders, which other CPAs intuitively make thinking it's like another business when it's nothing like other businesses. And those intuitive inclinations lead to IRS and state exams, and you don't want those. So let's start with revised 2018 tax forms. The IRS made significant changes to the tax forms and schedules. So first, right off the bat, which I took out of the slide deck, is they talked about having a postcard, that they were going to make it simple. They just got rid of a lot of your itemized deductions. It's not a postcard. It's still 2 pages, the 1040, but it is shortened. But that's only because they took information off it onto 6 schedules, 6 Schedule 1s that go with the 1040, and they added more line items like the qualified business income deduction. The big thing to focus on is that Schedule A. That's where you got hurt. Individuals got stripped down of a lot of deductions for some reduction of tax rates, and a lot of the tax benefits went to corporate America and the pass-throughs. So they suspended miscellaneous itemized deductions subject to the 2% floor. What's that? That's your investment fees and expenses, all your trading expenses if you don't have trader tax status, except for margin, interest, and stock borrow fees. Your job expenses, you're unreimbursed. So now you got to get reimbursement in your job. Your tax compliance, you come to a firm like this, it's not deductible, except if you have trader tax status, then it's a business expense. So they just on Schedule A just flat out removed the job expenses and certain miscellaneous deductions. And they added this, and they used to have this line for miscellaneous other deductions. Now they call it other itemized deductions. That's where the stock borrow fee goes. And Darren's had told me some war stories. They dropped this out, but they shouldn't have. They should have dropped this one out, but they didn't. That type of thing. It's not, between the law, the instructions, and the forms, there's stuff that's fallen through the cracks. Now you'll see on page 2 of the 1040, the qualified deduction and worksheet for the qualified business income. So let's say you're a doctor, lawyer, consultant, you own a restaurant. You might be getting a 20% deduction on that income. It's got to be qualified income in a domestic business within the U.S., and there's all sorts of haircuts, and the IRS does not currently provide a tax form for it. There is one next year for the simplified method. So it's a complicated deduction. Your software is going to figure it out, sort of like an NOL worksheet, or it's sort of like, it reminds me of SE type, SEI, and the SE tax. It's a whole other regime. The software will generate it for you. You're looking for elements of QBI income or loss, W-2 wages, property limitations. Then it matches up to, it looks at QBI versus the taxable income, takes the lower of, there are income caps for service businesses, you're priced out of it. Very complicated deduction. How does it affect traders? That's what a lot of people want to know. The final 199A, that's the reg for QBI, it labels trading a specified service trader business like a law firm or an accounting firm. And that's not good, because then you got the income cap. If you're married and your taxable income is over 415, $1 over, you don't get a penny of this deduction. If it's $1,000 under, you get 1/100th of the deduction, and even less than that, because it phases out at 100,000 under the 415 or 50,000 under the 2075 for single. So specified service trader business, if you're making a lot of money, you may get nothing. If you're in the phase out range, you may get some. If you're under the income threshold, you can get the full amount. But the million-dollar question is, do traders have qualified business income? And it's confusing, and there are conflicts in the law. If traders are a specified service trader business, then their expenses are QBI losses. Well, people don't want QBI losses. It can upset or reduce a QBI deduction from your other business or your spouse's business. So you might want to file separate this year. To maximize QBI deductions, you might want to file separate. The new tax law got rid of the penalties for filing separately, or most of them, in terms of the brackets. Now, here's the problem for traders. The QBI expenses are QBI, but QBI excludes all capital gains income, Section 988, and swap ordinary income, dividends, interest income. The only thing left that's included in QBI income is 475. Not every trader has 475. Some traders and hedge funds don't want QBI treatment. Others want it. There are conflicts and unresolved issues in the law. So read my brand new blog post about it that was published last night. And just come to the website. There's a lot of new blog posts. Every week you got to check in with us. You have to file your extensions. Don't rush to file this year. Now, you're going to probably get your Schedule K-1s late, because they're struggling with these QBI issues and unresolved questions, especially the hedge funds and the trading companies and other businesses too. And if you look at the partnership instructions, you're going to see the QBI items on line 20, other information. So it's not a line for regular tax and not, it's the other information. Now, by the way, there used to be a line for the investment expenses. That's gone. Now it's an M1 adjustment, Darren was telling me yesterday. So it's other information. You'll see code Z for 199A income or loss, code AA for the 199A wages, because there's a wage limitation. Once you get into the phase out range and above the income cap for a non-service business, you don't just look at QBI, you have to look at the wage factor. You got to have a lot of wages and or property, and that makes it more confusing. So due to complications with the QBI regulations, taxpayers should expect delays in receiving final K-1s for 2018. A lot of hedge funds, they don't want QBI losses from expenses. They don't have 475. They don't have QBI income. They don't want to deal with it. They don't want to have to, give it to investors who ask questions about it. It's a state of flux right now. So let me turn to my partners at the end of each section. And this is where the gold in this session is today, is to hear from my partners. We don't always hear from them on the webinars, and it's a great opportunity. So Darren Neuschwander, my co-managing member, this tax season, several brokers are correcting 1099Bs. I don't know if Wedbush has for Lightspeed, but we've heard some other firms are. Schedule K-1s will likely be late. And the new law is confusing, especially the QBI tax treatment. Are there conflicts in the new tax law versus the 2018 tax forms and instructions? Some of those things you were telling me about. Could you tell us some of the issues, and do you think traders and why traders need extensions this year?
Well, Bob, I think this year more than any, traders really need to file an extension. I mean, as you were mentioning, there's some issues still lingering that we're trying to get guidance on traders and qualification for QBI or not. So that in itself is a reason why a trader needs to file an extension. There's some new clarification with the trader that may claim the home office, but it's taking the standard deduction. And I think we get into that later in the slide. The whole 1040 has changed. I kind of laughed when I saw the initial part of this presentation, the Lightspeed cover, which was basically the old 1040. So if you haven't actually opened up a 1040 this year, it doesn't look anything like it used to look. What used to be 2 pages is now potentially 6 pages. And it's very confusing to a lot of taxpayers just with the new format of the 1040. So it's going to take you a little bit of time to get accustomed to it. And I mean, today is March 6th, and we're getting close to the April 15th deadline, and people are still getting their 1099s and trying to rush that with the new tax law changes and making sure that you're getting everything that you possibly can get. It's kind of rushing things. So I would suggest filing an extension for that reason. Give yourself the additional 6 months to October 15th and make sure that you're getting your tax return filed accordingly.
Darren, do you think people owe a lot of money this April 15th? Maybe being under withheld on wages or losing deductions? Have you been getting blowback from clients? Like, what happened to the so-called tax cut?
This year, I mean, overall, the amount of refunds that people have seen in previous years has been dramatically less. We've had taxpayers that have been in a refund position almost every year, but because of the tax law changes, they're being surprised that they actually owe when they file their tax returns. One is because they may have had W-2 withholdings in the past, and if those W-2 withholdings were adjusted because of the new tax law, the withholdings were less. And then if you're in a high income state like California and New York, where you used to get all of your state and local deductions, tax deductions, as an itemized deduction on your federal return, you're now being capped at $10,000, and that's a big blow. So even though the standard deductions increased, people in the high income states are really getting hit with that. So overall, yes, there are tax savings because the brackets did decrease, but overall the refunds are not what they used to be. So trying to work up a return for an extension in the past where we could almost predict that a client was going to be in a refund position, this year we're having to take additional time and making sure that we have everything, because we want to make sure that the client is paid in by April 15th, even with the extension. And that's the key, making sure the extension is not an extension to pay. If you owe, you still have to pay that by April 15th. That's not an extension to pay it. If you decide not to pay it, you'll have to pay additional interest and penalties when you actually do file it. So don't recommend filing an extension and not paying what you owe. You need to make your best guess estimate of what you owe and paying it as much as you possibly can so that you don't get hit with any late payment penalties or interest on that liability.
Now, if they can't pay, they still have to file the extension. Otherwise, a late filing penalty, which is much greater than the late payment penalty. And we have blog posts about this each year. Let me turn to Adam Manning. Thank you, Darren. Adam, how should traders go about filing extensions for the past due entities that are due coming up almost a week from now, March 15?
Yeah, the entity extension's simple one form. It's the 7004 that they can either download, or if they signed up with us, we can easily help prepare that. It's a simple form. You basically just print it and mail it in, fill it out with your information, and that's all you have to do for the entity pass-throughs. It's a little different for the individuals. It's also just one form for the individual, but as Darren said, you have to make sure you pay enough tax with that individual. With the entities, there's no issue there unless you, of course, with the pass-through entities, there is no issue. If you have an 1120, then you need to see if you have tax as well. But it's a little easy for these pass-throughs. And as we said, for an individual, you got to make sure you see if you owe any more tax, make sure you pay that in so you can avoid any penalties and interest.
Now, everyone should take a look at the blog post just published minutes before this webinar. March 15th is tax deadline for S Corp and partnership extensions and elections. It goes through what Adam and Darren were talking about for the entity. Also talks about the S Corp election. That's due March 15th, the Form 2553. If you've been a single member LLC or a spousal member LLC in the past and you want health insurance and retirement plan deductions for 2019, this is the deadline, March 15th, for the S Corp election for an existing entity. It's also the deadline for the 475 election for the S Corp or partnership. And you'll see later in this presentation how important 475 is. So take a look at that blog post too. So let's go to the next section. Maximize business, home office, and startup expenses. Traders eligible for trader tax status can include a Schedule C for these valuable deductions. You got to properly assess qualification for TTS. Many traders don't claim it when they're entitled to. They just don't know about it. Their local accountant thinks it had to be elected. It didn't. So the accountant doesn't know it. They stay shy of it. They confuse it with 475. It's two separate things. You can claim it for 2018, even prior open years. But there are others who don't qualify and they claim it anyway and they take their chances with the IRS, and we deeply frown upon that. It's so important this year more than ever. It unlocks the business expense treatment, full ordinary loss deductions. Investors may not deduct investment expenses as an itemized deduction for regular tax. They can't even deduct it for the Obamacare 3.8% net investment tax. TTS, trader tax status, is more crucial than ever before. See my current blog post, just a couple of weeks old, how to qualify for trader tax status for huge savings. It goes through all our golden rules. I'll probably post these slides on our website page for this event, and you can click on those to click through the links. Now, the business expenses include tangible personal property. You buy a computer for $2,000, it's a property expense. You got to make sure everything is invoiced for $2,500 or more. There's a safe harbor election that goes with this. This was a liberalization of expensing. If you don't get that, the item is $3,000, you can get 100% 179 depreciation or otherwise other types of depreciation. The amortization applies to startup costs and your intangible costs, organization costs, Section 195 startup costs. That's amortization. Education expenses paid and courses taken after commencement of TTS is a business expense. Let's say your TTS started July 2018 and you took some classes before and some classes after. Well, the ones after the start date, that's a business expense. The ones before, going back 6 months before inception, you can capitalize as a Section 195 startup cost and then amortize it up to $5,000 the first year and the rest over 15 years. So it's very tricky when you start trader tax status. What is the start date? When you started the pattern of qualification, you might have ramped up. You might have started in March, but not really qualified until June. So your pre-business versus post-business is very important. You may want the accrual method. There's a lot of nuance in the deductibility and how you handle things. So Get Green's 2019 Trader Tax Guide, there's a whole chapter on this. And this is where my partners add a lot of value to clients in maximizing business deductions, and education and the startup costs are a real big one. Otherwise, your publications, market data, professional services, including most of our fees, chat rooms, mentors, coaches, supplies, phone, travel, seminars, conferences, assistants, consultants, the works. A real big one is the home office deduction for the business portion of your home. It's a very nuanced deduction. It requires a lot of special strategies for traders. your margin interest expense, your stock borrow fees for short sellers, your internal use software for your self-created automated trading systems. That required capitalization under 174 and amortization. So there are some tricky rules. They're in the guide. Don't miss out on these deductions. Now, don't go overboard and think you're going to buy an SUV for your trading business and get a heavy or a luxury vehicle depreciation. You're not a flower shop delivering flowers. And what business purpose you have for a car? You're not visiting client companies. Now, your brokerage commissions, yeah, that's a big expense, although it's gone down over the years. Depends on how active you are and if you're using a low-cost broker. But they're not separately stated expenses. They're part of your trading gain or loss. So if you have a large capital loss limitation, in a sense, you're getting your commissions as a carryover capital loss. If you have net income from capital gains or Form 4797 marked with Section 475, you're getting the full benefit of those commissions, and there's nothing you can do about it. You can't override that treatment to treat it as a business expense. Believe me, everything that's possible to do, we've kicked the tires on it to see if it can be done. So now in the home office, it's one of the most significant tax deductions for traders. Don't go overboard. You know, it may not be a separate room. You may cordon off an area with a desk, a chair, your computers, your screens. It's a sophisticated setup. You don't let the kids play with that stuff. So it's got to be exclusively used for the trading. A lot of the deduction requires income. The mortgage and real estate tax doesn't, but it has a very peculiar interaction with the new tax law, whether you're taking the standard deduction or the itemized deduction, because they're so concerned about people doubling up a benefit. So Darren's going to talk about that a little bit. That will throw you for a loop. On the one hand, you're trying to navigate around the SALT limitation, but they're not really letting you do that fully. There are complications, whether you itemize or take the standard deduction. And don't shy away from depreciation. That's allowed or allowable. You want that. You still can get the exclusion on the sale of the home sale exclusion. It's a nuanced deduction for traders. It might require a transfer strategy, although there's another way to do it in the forms itself. A lot of people miss the boat on this when they should not. It's a powerful deduction. With the S-Corp, you got to submit it for the accountable plan for reimbursement. Now, again, on the startup cost, you want to go back 6 months. That's a reasonable period. Capitalize a reasonable amount, and then expense up to $5,000 the first year, and the rest over 15 years. If you leave the business, you write off the unamortized amount. So let's talk to Darren and Adam again. Darren Neuschwander, tell us what's new in calculating a 2008 home office deduction and about the confusion that you're going to see that people are going to have with the new law, the revised 8829 home office deduction form, and a little bit about that integration with the itemized versus standard deduction. How can traders maximize this deduction, the home office?
Well, first, before we get into that, let me just say, if you're looking to file as a trader with trader tax status, you may talk to your local CPA about it, and he'll say, no, you don't want to claim the home office deduction because that's a red flag. Well, that's not true. We highly encourage, if you do qualify to claim the home office, claim it, because it, in our opinion, and this is actually, we've had some IRS exams where this actually helped with someone claiming trader tax status. This is your place of business. This is where you do work. So claiming that deduction that you're eligible for, you should claim it. It's not a red flag. You should claim it. Now, with that being said, before the old the tax law change with the old laws, whether you took itemized deduction or you took the standard deduction, if you had real estate and mortgage interest, you could take a percentage of the real estate tax and the mortgage interest paid on the home office deduction. And you would get that whether you took the standard deduction or whether you took itemized deduction, you would still get that percentage as a business expense on your Schedule C as a trader. Whether you were not profitable, you had no income for the year, you would still get those two deductions on the Schedule C. with the new tax law, and again, the only place that we have seen this so far is in the instructions and the publications for 2018. To our knowledge to date, nothing has been changed in the actual IRS Treasury regulations. And we have a question to the IRS about that, but I don't think we're going to get clarification anytime soon. But the way that the new forms and the publications are written is that if you are taking the standard deduction, the new higher standard deduction, and you do not have trading profit, then you will not get the benefit of the percentage of the real estate and the home mortgage interest that's allocable to your home office itself on Schedule C. You will not. You have to take the you'll have to itemize before you'll get that. So as long as you're itemizing, the rules are basically the same as before the new tax law. You'll still get a percentage of it on Schedule C, and the rest will be as a Schedule A itemized deduction. But if you're taking the new higher standard deductions, married, felon, joint, 24,000, you will not get that on Schedule C. So imperative that you have profit from trading. If you don't have profit from trading, we can still file as a trader. You can still report the home office, but if you're taking the higher standard deduction, you may not have the home office deduction that you can take currently. Still report it. The reason you report it is because if you can't claim the home office deduction for the year, those expenses are not reportable as a deduction in the current year, but they carry forward to a future tax year. So just don't ignore it saying, oh, I'm not going to get any benefit, I'm not going to do it. Still report it, because you may be profitable in the next year, and we can get the home office deduction for that year. And if we have enough trading profit, we can claim the home office deduction that was carried forward as basically a suspended expense. So again, if you're in the business of trading, don't think about the old red flag, I shouldn't claim the home office. You really should if you have a true home office setup.
Darren, if you have trading gains, it still applies that you don't get the Schedule A portion of real estate tax and mortgage interest if you take a standard deduction, or is that not the case if you have gains?
It's not the case. It's not the case if you have gains. If you have enough gains, and when we say enough gains, you have to have trading gains less your other trading related expenses. So after you take into account your other trading related expenses, computer equipment, data fees, etc., if you still have a net gain after that, then you still can claim a part of the home office deduction and get a benefit for it, even if you take the standard deduction. It's in a year that you have a loss from trading that, and also take the new higher standard deduction, you will not get any benefit of the home office deduction in that current year.
Great. Thank you, Darren. Adam Manning, home office, computers, other equipment, education, margin interest are significant business deductions for TTS traders. But there's all sorts of little deductions that are smaller than that. How do most traders, like our clients, keep track of their expenses? They don't bring in a shoebox of receipts the old-fashioned way. Some of them give Excel worksheets or accounting. What do they bring? How do they keep track of it?
Yeah, you're right. We don't ask for all your receipts and everything when we do the return. We provide our clients with an Excel spreadsheet organizer where they can list their expenses in that, or we also provide them an Excel tracker, which is an expense tracker where they can monthly keep up with their expenses. And if they do that, then at the end of the year, it's already summarized and in the correct categories that we like to use. So many of our clients just use that Excel tracker on a monthly basis, and then at the end of the year, that part of their return is done. They've kept up with their expenses, and they can easily just provide us that Excel sheet. We do have others that maybe use QuickBooks or Quicken to keep up with their expenses. I do caution them not to try to put their investment account or their trading account in there, because that does kind of usually there's more work for us to fix the QuickBooks if they do that, as opposed to just using that to track their expenses. But
now the expense tracker, that's, I imagine, single entry. You just keep track of the expenses. Do you think clients need a full accounting solution with debits and credits for entities? Do we want that versus sole proprietor traders?
I don't think, we don't require it. And like I just said, I think sometimes when we try to put everything in, if they're not used to the accounting purposes and trying to keep everything in the QuickBooks, oftentimes there ends up being just too many adjustments in there. It's almost simpler if they can just keep up with their expenses in that Excel sheet and provide that to us, as opposed to trying to do their own accounting and keeping up with it and then having us fix it down the road. That saves them some money on our time of trying to do the accounting work.
Now, when you do an entity tax return, I know that Darren and you have very high standards for quality control. Do you guys insist on debit and credit full balance sheet accounting for the entities?
Yes. We for all our entity returns, we prepare the Schedule L, which is the balance sheet on the tax return. We also have a trial balance software that we produce a profit and loss statement and a balance sheet in. So we have a trial balance that we produce along with the work papers that we prepare, and then we use that to prepare the tax return. So when we get done with an entity tax return, it has a complete set of books basically that we've got put together to support all our documentation.
But for the sole proprietor trader, there's no balance sheet, right?
No, there is not.
Just the Schedule C.
That's it. Yeah, for a sole proprietor trader, we just pick up their expenses on the Schedule C and then report their trading activity on the appropriate form.
Now, Darren, on the home office for the partnership versus the S corp, how would you want people to handle the home office deduction?
Well, for a partnership, the home office deduction is not reported at the entity level. At the partnership, it is reported, if deductible, it's reported on Schedule E as a unreimbursed partner expense. UPE is what it's called. So partnerships, very straightforward. You prepare the partnership return without the home office deduction, and then we consider the home office deduction when the individual return is prepared as part of UPE. Now, for an S corp, it's a little bit different. For an S corp, salary is required, and if a salary is paid, then part of the accountable plan, you can be reimbursed for the home office deduction, and then that deduction itself is reported on the S corp return. So those two are a little bit different.
And the S corp requires the accountable plan before year end. It's use it or lose it.
Yes.
Well, excellent, partners. Let me move on to the next section. Don't solely rely on broker form 1099-Bs. We've been talking about this for decades now. There might be opportunities to switch to lower 60/40 capital gains rates in Section 1256 or use 475 ordinary loss treatment unless the 1099-B is set up for 475. But you got to elect Section 475 on time, and you need to have TTS to use it. So it could be dangerous if you tell a broker, hey, I want 475. I don't want those wash sales. But you never elected 475 on time, or you don't have TTS, you can't use 475. You got to cross all your T's and dot all your I's. Now, the biggest issue of all is that the IRS rules for brokers on wash sales are different from the rules for taxpayers, causing further confusion. The IRS rules for brokers, the 1099-B reports wash sales for the one brokerage account based on identical positions. So Lightspeed, Wedbush issues the 1099-B. It looks at just that account, not that other account that your spouse has or the second account that you have, not your IRA account, or not another brokerage account which you have. A lot of traders have multiple accounts. They only do it on the one account, and they only do it on the identical symbol. But the IRS rules are different for taxpayers who must calculate wash sales based on substantially identical positions across all their accounts, including joint, spouse, and IRAs as an individual. Substantially identical means between the underlying equity and the option. Apple equity, Apple November options, Apple December options. They're all potentially wash sales. The broker doesn't pick up a wash sale between an equity and an option, or an option at different strike dates. So we see the speed limit sign on the side of the road. We're CPAs, sort of like adopted deputies of the IRS force. We're third parties. We call the balls and strikes. We know the right way to do it. We do it the right way with trade accounting software that we use that retail traders can get on their own as well, that follows the rules properly. We've been doing it properly for as long as I can think. industry practice, a lot of local CPAs, a lot of software companies say just import the 1099B, and they ignore the speed limit. They ignore that sign, and they've gotten away with speeding for years. But the IRS can lower the boom at any time and cause a lot of heartache for a lot of people. So I encourage you to do it correctly. If you want to bypass some of the complicated accounting, and how complicated it is to run software, you run it, you press a button, and it's done. It's not that complicated. It's not that expensive. If you try to figure out wash sales manually, it will stump you. But if you use a good software that's IRS compliant, it works well. So in many cases, the broker is reporting wash sales different. Now, if you do it correctly, if you slow down because of the speed limit, okay, you're going slower, but you may not crash. I'm abusing the analogy here to make a point. But the point is that other account that you have that you bring into the calculation, that might absorb the wash sale. That might have a big enough gain to absorb the wash sale. This year, more than ever, this is one of those years where the wash sale numbers are freaking people out. And it makes sense, because here's how you prevent a wash sale, and people didn't do this. You got to break the chain on the wash sale losses at year end in the taxable accounts to avoid wash sale loss deferral in 2019. So a lot of people did tax loss selling in December. They sold positions. The market was melting down. They didn't know what was going to happen. They sold. And let's say they sold, FANG stocks or whatever in December. If they had the discipline not to buy it back, not to buy back an option or an equity on it in any of their accounts for 30 days, they had to wait 30 days of not buying it back, they could have avoided the wash sale. They could have broken the chain. But that may have been the plan, but it went out the window with the rally in January. The stock sold off in December, sell, wash sale loss. If you could wait 30 days, no wash sale. But who could wait 30 days? Jump in January, catch the rally. Okay, it's a wash sale loss deferral, but at least I caught the rally. So that's a big thing this year. There are $1 million wash sale disallowance numbers on these 1099Bs. People are freaking out. It may be a wash sale disallowance for the year, the same wash sale counted over and over. It can say $3 million when you didn't lose more than a couple $100,000. That's all you had in your account. What matters is the wash sale loss deferral at year end, or any wash sales that are permanent that you generated with an IRA. You took a loss in a taxable account. You didn't know that you couldn't buy it back in your IRA. The broker doesn't say that that's a problem, but our software picks it up as a problem. That's a permanent catastrophic problem. And the way to avoid it, if you're trading as an individual and you don't have 475, that's the best way to avoid all this, because then there are no wash sales. It's mark-to-market accounting. There is no year-end deferral. But it's too late for 2018. You can't elect 475 for 2018. So maybe you do that for 2019. So another nice way to avoid it with the IRAs is a do not trade list. You trade your FANG stocks, if people still use that term, in your taxable account, and you trade other stocks, your energy stocks, or you make mutual fund investments or whatever in your IRA. You don't like wash sales? You don't want 475? You don't like this whole headache? Trade 1256 contracts. It's a different type of thing. I know a lot of Lightspeed traders trade equities and equity options, but there's some futures 1256 contracts too. It's mark to market by default. There is no deferral. You're not going to hold on to a long-term capital gain, but you get those lower 60-40 capital gains rates. 60% is long-term, 40% is short-term, no wash sales. So again, I told you this to start. We can depart from the 1099Bs. If you have the volatility ETN prepaid forward contracts like the VXX, that's the #1 ETN volatility product. The 1099B might pick it up as a security because that's what the exchange says to do. And so, okay, there are war sale loss adjustments. Or no, I have 475 at security, so I use 475. But we found substantial authority to handle it, the ETN prepaid forward contract, not as a security. If something's not a security, then no war sales, no 475. The same for crypto. It's not a security. So now the ETN debt instruments like the UGAS, that is a debt security. So you got to read our content. And again, you'll see how the CBOE listed option on ETNs, they're listed as a security on a lot of 1099Bs. Not every 1099B is the same, but we have substantial authority to interpret it as a non-equity item. The ETN is not a security, so the option on the ETN is not a security, and it's listed on a CBOE qualified board of exchange, so presto, 1256. A lot of foreign futures. The broker might say, hey, we got clearance from the CFTC that it's like a U.S. futures contract, and we can market it to Americans. But it's not 1256 unless they have a revenue ruling. ICE has that revenue ruling, but a lot of foreign exchanges don't. So sort out the tax treatment. Now, let's say you're trading commodities ETFs, publicly traded partnerships. They issue you a K1. Oh, no, anytime you get a K1, there's a whole lot of instructions and pass-through income. So you got to report that 1256 income on your tax return. You got to go ahead when you sell that ETF. It's a sale of a security. So it's short-term, long-term capital gains treatment. You're selling a security, but you got to make a cost basis adjustment. You got to add that pass-through income to the cost basis. The trade accounting software won't do it. The 1099B won't do it. You got to do that manually in the software. Margin interest versus stock borrow fees. We talked about this before. I talked to Rob on the call before we got started. Brokers, you want them to have the capability of breaking down for you, maybe not on the 1099B, but if you ask them, you want them to have the capability, which Rob said he thinks Lightspeed has, to tell you what is margin interest versus stock borrow fee, because those are the two items that investors can still deduct. All your investment expenses and fees are gone unless you have trader tax status. But your margin interest is reported on the Schedule A as investment interest expense. Why is it so important to treat it differently from the stock borrow fees? Because investment interest expense is limited to investment income, dividends, interest. You can include capital gains too. And you may not have much interest in dividends and capital losses. So you may get stuck with a margin interest, investment interest expense carryover. It could be a big number. If it's a stock borrow fee, it's fully allowed as an other itemized deduction. So look for those numbers, you short sellers, and Lightspeed has a lot of short sellers. Now, not every brokerage firm allows you to do this, but some brokers give you the opportunity to tell them, hey, I'm using 475. So you can request the 1099B based on 475. So it comes without the war sale loss adjustments and MTM at year end. And the broker does not generate a Form 4797 Part 2 for you, but you could probably attach that 1099B as to your tax return and or just put in the totals to a Form 4797. Now, here's the problem with this practice that I don't like. The broker's not checking if the client has TTS. The broker's not determining that the client elected 475 on time. And I know that a lot of traders, if they're given an opportunity to say they have 475, even if they don't, they may say they do. And that's not ethical and it's wrong, and we would never go along with that as a firm. So, but it could save you a lot of headache in terms of reconciling to a 1099B that has wash sales. So let me talk to my partners again now. Darren Neuschwander. Many traders realized they sold and they have significant capital losses in December with the steep market correction that I was talking about. They repurchased substantially identical positions in January to catch the enormous market rally. It was a good market move, but now it's a perfect storm for wash sale loss conditions. It's bigger this year than it's been in recent years. Traders get alarmed when they see these massive wash sale loss adjustments on their 1099Bs. They don't know whether it's for the whole year or just year end. Different brokers do it differently. Darren, Neuschwander, how should traders deal with wash sale loss adjustments, 1099Bs in their tax returns?
Well, it's interesting you bring that up because I'm trying to address questions as we go along, and that was one question that was brought up. Individual actually got his 1099, and because of wash sales, he sees that he potentially has to pay more tax than what he thought he made money on. So my recommendation on this, which was the recommendation I made to the individual, is if you're unsure that the wash sales are calculated correctly, then I would suggest looking at our trade accounting service. It's a separate service than our tax preparation, especially if you're trading in multiple accounts, because, and even if you're at the same brokerage firm and maybe you're married and your spouse has an account in his or her name, and then you have an account in your name, or maybe you have a joint account, the broker is only required to calculate wash sales for what happened in that one individual account. They don't have to go across the board. So if you have, even if you've got an account with one brokerage firm and a competitor brokerage firm, they don't talk to each other. So you may have had something that triggered a wash sale at one brokerage firm, but maybe because of what you actually did in the other brokerage firm, that wash sale truly did not exist. The only way to do that is to combine all of your trading activity into one overall gain and loss report. And that's what we do in our trade accounting service. We take all your brokerage account activity, combine it into one gain and loss report, and run the wash sales. And if you're also trading inside of your IRA, we take into account your IRA also. So if you did get a 1099 and you're concerned about the wash sale calculations, let us take a look at it, especially if you're trading options. If you're trading options in addition to stocks, sometimes you may have a wash sale or may not have a wash sale because of something that happened with the option. So you're trading Apple, and then you may have been trading some Apple puts and calls. That in itself could potentially trigger a wash sale. So look into our trade accounting service. You can see that on our website. I would encourage you to sign up for that soon, because we only have so many hours left before the April 15th deadline, so much availability of professional time. So don't delay on that, and take a look at it as soon as possible.
Now, Darren, I've had a lot of consultations with the following scenario: a massive capital gain for 2018. Client lost money. They lost $100,000, but the wash sale loss deferral is causing them to have to owe taxes on $300,000, and they have to pay that tax bill April 15th. So they need to know, how much do I owe? And they don't want to pay it, but they have a massive capital gain. And then they get a double whammy. That capital cost basis that's deferred until January leads to a huge capital loss in 2018, and then they have a capital loss limitation. In the old days, we could have a 475 election, ordinary loss treatment, do an NOL carryback. We can't do that NOL carryback anymore. There's a double whammy, and it's very important to figure out if they need a 475 election, because that can turn that Q1 loss into an ordinary loss. So the 475 can bail them out this year, not last year, but this year. So get a handle on this, folks, and consult with me about this 475 election, because you got to see what moves you can make to help yourself. Adam Manning, what are some of the issues that you've noticed so far this year with 2018 1099Bs? And I know we haven't seen a lot of them yet because they've just come out and clients are getting us the basic information. But what have you noticed with the 1099Bs, the broker tax reporting, and do you also recommend the trade accounting service?
With the 1099s, yeah, the corrected ones, we haven't seen many out yet, but the ones that did come out and we have seen some corrections, and some of them are small corrections, just something with the new tax law changes, the Section 199A dividends. It may be a change to that, or just maybe just the change in the dividend amounts. So we have seen the corrected 1099s, which is why we also ask that people and suggest that they file extensions to let the brokers get these corrected 1099s out before you file and then have to amend a return. You know, we haven't seen much else that's yet on these 1099s. Like I said, we're just getting into the heat of these things. They just came out, most of them, towards the middle to end of February. So, you know, like we talked about earlier, the margin interest and the borrow fees, just knowing where those are picked up and add on your broker 1099. Sometimes those borrow fees are on there, sometimes they're not. You have to look for them elsewhere. So those are things to keep in mind when we're trying to prepare these returns.
All right, let me move on. Now, Rob Lifson, can we go late? I meant to ask you that before. Do we have a hard break because we're running
Sure.
out of time?
No, that's certainly up to you guys.
All
We're
right, we'll
happy to
go
have
late.
you answer more questions and present as much as you'd like to give us.
Good. Now, I want to just revisit a point before that Darren said. Every client of ours that uses trader tax status that has a Schedule C potentially has a QBI loss, qualified business income loss from that Schedule C expenses, unless they zeroed it out. And even if they zeroed it out with capital gains, they still have a QBI loss from the expenses because capital gains are not QBI income. So you all need to be on extension until that issue is resolved. So let's talk about the Section 475 election. It's a very powerful section of the tax code. It's part of green trader taxes history. It came out in 1997. We told traders to adopt it. Every market crash, people are really grateful that they have 475 ordinary losses rather than the capital loss limitation. They don't like wash sales. It's a ticket out of that too. And you might become eligible for a QBI income deduction, although that's uncertain at this time. Tax loss insurance, that's what we call it. The chief tax benefit was deducting your trading losses without limits. Exemption from those onerous wash sale loss adjustments. You had a big loss in December, you're going to get that loss on your tax return. You're not going to get zonked with phantom income, triggering a tax bill. You're not going to get stuck with a $3,000 capital loss limitation, which has never been indexed for inflation, and then these huge capital loss carryovers. It's too late to elect it for 018. You got to decide about 019 now. Don't forget 19 planning. You got 018 returns and 019 planning. Now, as far as the QBI deduction goes, with the advent of the new tax law, Section 199A, traders might derive an essential tax benefit from Section 475 ordinary income. TCJ introduced the 20% QBI deduction. QBI includes 475 ordinary income or loss, but it excludes capital gains and losses and Forex ordinary income and dividends and interest. Trading is a specified service trade or business, which means the QBI deduction, if it's allowed, it's going to be disallowed if you're over the income cap. Now, however, this QBI treatment is uncertain. There are conflicts, and Section 864 may deny the treatment. There are unresolved questions. Stay tuned. A lot of people don't want the QBI treatment. Some hedge funds, they don't have 475 income. They only have the losses. They only see the downside. For a lot of traders, they don't want QBI treatment. Other profitable 475 traders want it. If I look at all our clients, a lot of them don't use 475, and a lot of the ones who do don't necessarily have gains. So this thing, which side of the fence you come down to on QBI really depends on where you stand. So it's uncertain, and let's see how it pans out. If you want 475, focus on the tax loss insurance. That's the time-tested gold. That's the real benefit. The QBI is tertiary and uncertain. So it's 475 is optional. TTS is undergraduate school, 475 is grad school. Not every trader wants 475. Existing taxpayer individuals that qualify for TTS and want it have to file the 019 475 election statement. It's a simple one-pager. You staple it to your paper filed 2018 extension, or you include it in your tax return, which you want to go on extension, as I pointed out. So you can't e-file the election. So you paper file and staple the election to it. Existing partnerships and S-corps do that with the 7004 by March 15th. Go to the blog post. It gives all the information about it. And the guide gives you more detail. Now, Darren Neuschwander, over the years, we've noticed many TTS securities traders regretting they didn't make a 475 election on time. They had whopping losses. They come to us all the time at this time of year. I think I qualified for TTS. Can I use the ordinary loss treatment? And it's too late for them. Now, it's not too late now for this year. How do you explain the tax benefits of 475 to our clients? What are some of the ways you get the message through?
The way that I really think that you need to really encompass mark-to-market accounting is look at it as insurance. Okay, if you own a home, you purchase insurance on it. You don't purchase the insurance for appreciation on the home. You purchase the insurance on the home for in case there's a fire. And that's what mark-to-market is. Because if you're trading short-term capital gains, and that's what a trader is, supposed to be trading short-term. Short-term capital gains are taxed at whatever tax bracket you fall into. If you elect mark-to-market accounting, it's ordinary gain taxed at whatever tax bracket you fall into. I'll put a little asterisk on this. Wash sales have to be considered into this. So if you elect mark-to-market, you don't have to worry about wash sales. But ignoring wash sales, as long as you're profitable, you're going to be basically taxed at whatever tax bracket you fall into, whether you do or you don't elect mark-to-market. Where the fire insurance kicks in is, let's say in a given year you had a loss of $100,000 from trading. Again, ignoring wash sales. Short-term capital gains, assuming you've netted all your short-term capital gains and your long-term capital gains, if you had any, and you had a $100,000 loss, you're only going to be able to deduct $3,000 of that loss against other sources of income for the year. Now you got a capital loss carry forward going to the next year of $97,000. With mark-to-market accounting, the insurance kicks in. It's going to help you. That whole $100,000 loss that I'm giving you in this example is fully deductible in the year that you incurred it and can be offset against other sources of income. So if you're married, filing joint, your spouse has a W-2 job, it can reduce that. If you had some retirement distributions, it can reduce that. So it's very important that you consider electing mark-to-market for that insurance piece. Now I'll add to this. A lot of clients come to us and they have what we call tax baggage. And it's where you had, maybe you were an investor, maybe you were trading and you never elected mark-to-market, but you've encompassed some large capital loss carry forward already. And then you're saying, well, I want to elect mark-to-market for the given year. Well, hold up. That's not quite an easy decision to make. And that's where we need to have a consultation with you, or for preparing your tax return, that's where we need to have a hard look. Should you elect mark-to-market? Because it could adversely affect you. Because if you've got a $100,000 capital loss carry forward, and let's say in 2019, you're already on track to make $100,000 for the year. Well, in that case, you may not want to elect mark-to-market as an individual, because in that case, that $100,000 gain would be offset against that $100,000 capital loss carry forward dollar for dollar. You wouldn't pay any tax on it. But if you elect mark-to-market, then that $100,000 gain is ordinary gain, and it can't be offset against that capital loss carry forward except for the $3,000 you get for a year. So in a case like that, a consultation is really needed so we can evaluate what's going to be the best strategy for you. And we really want you to get through the first quarter of 2019 to kind of see how you're doing. Are you on track to make a profit? And if so, then there's a strategy for that. And that's what we can discuss in a consultation. It may be that you don't elect mark-to-market as an individual, but at the point that you basically zero out your capital loss carry forward against your current year gain, maybe we set up an entity for the rest of the year that has mark-to-market. So you kind of have your cake and eat it too. You protect yourself for the rest of the year. You have the fire insurance. So don't just assume that you always want to elect mark-to-market. Everybody's facts and circumstances are different, and that's the reason we just don't give blanket across the board answers to this. We want to see, what are you doing? What is your situation? And that's what we do in a consultation.
That's great, Darren. Now, Adam Manning, what are some of the misconceptions that traders and accountants have about Section 475? How do they get confused? Can traders still receive deferral and long-term capital gains on segregated investments? Is that going to be a problem? Can traders still get the lower 60/40 capital gains rates on trading futures?
So for the first question, the biggest misconception that I see, and we've kind of addressed here, is that many taxpayers feel like 475 and MTM, that being the same as trader tax status, and they're two separate things. Which that's the number one thing we normally go through in the consults is you got to qualify for trader tax status and have elective 475 to be able to have the mark to market. So that's the biggest misconception I see there. They feel like they're both hand in hand all the time, and they're not really the same. You got to qualify for one, and then you can have the election in place. As far as the deferral and long-term capital gain on investments, yes, as a trader, you can have mark-to-market accounting elected and use it for your trading account and have segregated investments and investment accounts. So that's still available, and you can also still have the futures activity. You can have an equities account that you have MTM on and have ordinary gain and loss treatment on that, and also have a futures account that has the 60/40 treatment and still receive that benefit.
Great. Thanks, guys. Let me go to the next section. Common errors on tax return filings. This is a good area. I mean, we've seen some botched returns over the years. I know, Darren, when we do the new client evaluation, you look at people's prior year returns, in this case, 2017, you probably see a lot of things. You probably have a wealth of knowledge to share with us today. Some accountants intuitively think, as CPAs or EAs, that traders, they're like other service businesses. They should enter trading income, loss, and expenses like normal sole proprietors on Schedule C. I mean, there's a whole area for revenue, cost of goods sold, but that's very wrong, and it often causes an IRS notice or exam. Trading gains and losses don't go on Schedule C. Only expenses do. And then you look like you have a big loser, and that could trigger an exam. So right off the bat, the IRS has not laid out the red carpet for you traders. We are always in no man's land. That's our problem. We're always trying to figure out how to work our way into a tax return, into the law. We're always that odd man, that outlier. And we're not big enough as an industry to command the attention of, let's say, the hedge funds, the brokerage firms, and the like. So some traders, they try to deduct significant capital losses on a Schedule C, even though they missed the 475 election. It's going to be a guaranteed exam. They're evading wash sale loss adjustments. They're evading the capital loss limitation. There's going to be accuracy-related penalties. It's a big problem. Section 475 trades, they go on Form 4797 Part 2. People may not realize where they go. They may think they go on Schedule C. Again, presto, you're going to get an IRS letter. Who wants to get an IRS letter in an exam? No one wants that. Only trading business expenses are reportable on Schedule C. And the net loss might be a red flag for IRS computers and agents. Now, we don't leave it at that. To erase the red flag or reduce it, consider transferring enough TTS trading gains, whether 475 or capital, if any exist, not investment gains and trading gains, transfer enough to Schedule C, line 6, other income, to zero out Schedule C, to unlock that home office deduction that Darren was talking about before, so you don't get that SALT penalty on it, and to unlock depreciation, to get rid of the red flag fact that you're not going to show income because you don't want the IRS asking about SE tax. It's an important strategy. We explain it in our footnotes. It's in the guide. It helps with certain states that don't allow losses, like New Jersey. You got to have great footnotes. And a lot of local accountants, they don't know what footnotes to use. Traders don't know what footnotes to use. Now, there are SE tax and NIT tax areas, self-employment tax, net investment tax areas. Some traders and preparers treat TTS trading gains as self-employment income. They put the income on Schedule C, which they should not. It shows a net Schedule C amount. There's self-employment tax. And then they go ahead and they do a retirement plan contribution and deduct health insurance. It's all wrong. Now, Only if they're a full member of a futures or options exchange trading 1256 is there self-employment income in Section 1402I. Most traders are not that. They may have an electronic corporate membership or a reduced membership. They're not full members of a commodities exchange trading futures. Now, on the other hand, it's not SEI, but it is net investment income for the net investment tax. You got to include your trading gains and losses in net investment income. If you're over the 250K married or 200 single, you have to pay the net investment tax. That's the Obamacare 3.8% net investment tax, NIT. Don't forget to deduct your trading expenses from NII. Now, you used to also deduct your investment expenses, but those are suspended for regular tax, and we had hoped they weren't suspended for net investment tax, but they are. They are suspended for net investment tax too. So these are some of the nuances that you got to get right that are not on the 1099Bs, not in the TurboTax. That's why TurboTax said TurboTax Live this year. Even TurboTax, the biggest of all the tax companies, they said, you got to do TurboTax Live this year. You need CPAs on demand. Okay, call up one of their CPAs and ask them any of these questions. You're not going to get answers. You need trader tax CPAs on demand. That's green trader tax. AGI deduction errors. So you went ahead, you thought it was self-employment income. It's not. And then you paid your SE tax, which you shouldn't. You didn't have to. Maybe you like paying into Social Security and Medicare and deducting half of it, but you should not have. You can't contribute to a retirement plan. That's an excess contribution. You got to fix that before April 15th or there are penalties. You can't deduct the health insurance. You don't have self-employment income. You needed the S Corp to arrange retirement and health insurance deductions as a trader, unless you have another source of SEI. And you had to do this before year end 2018. All right, you realize you missed the boat. Don't miss the boat for 2019. Consider that S Corp election by March 15th. The main benefit of the S Corp for TTS traders is the health insurance and retirement plan deduction. You want to deduct that $20,000 health insurance without any offsetting payroll tax. You want that solo 401k deduction up to $62,000 a year, where the income tax savings is thousands of dollars more than the payroll tax cost. Now, you don't want to miss a 1256 loss carryback election. Darren was really upset that the new tax law got rid of the NOL carryback. We did a great benefit for our clients carrying back those 475 losses. The fire insurance that Darren was talking about, we did the carryback. We got an immediate refund check or insurance check from the broker. It was wonderful. Now that you got to carry forward the NOLs, you get some of the refund, you get some of the insurance check for the fire insurance in the current year if your spouse has income, but then you got to do an NOL carry forward. There are no carryback opportunities left except for the 1256 loss carryback election opportunity. You don't elect 475 on 1256, you keep the lower 60/40 rates, and it has this loss carryback, but it's very limited. It's only against 1256 gains in the prior 3 years. There's no election that you have to file now. Whenever you get around to filing your 2018 tax return up until October 15th on extension, do it by then. You see you have a huge 1256 loss. You see you have no other capital gains. It's not doing you any benefit this year, but you had 1256 gains in the prior 3 years. You check the box on Form 6781, you do the carryback, and then you do amended tax returns. And I suggest you have Darren and Adam's team, or teams, do it for you so they do it right. Now, if you got a TTS entity, the S Corp needed to have officer compensation, formal compensation. We implored our clients to do it with Adam Manning, who's in charge of that. We set up a lot of entities, and then I pass the baton to my partner, Adam Manning. He sets up the entities with the right accounting system. He sets them up in payroll in December. We do payroll for the health insurance. If you do the retirement plan, we do it for the retirement too. It's all got to be done before year end through formal payroll. You can't do it as a sole proprietor, and it's extremely difficult to accomplish those deductions as a partnership because they pass through the losses. The S Corp doesn't. It's a quirky thing. I don't want to take you through the weeds right now. You got to have the right structure, folks. and do that with your year-end planning. Do that with me in a consultation now. Questions from my partners. Darren Neuschwander. Just a catch-all question. What are some of the areas that you've been noticing on prior year returns? You've looked at a lot of 2017 returns the last month when you've done these new client evaluations. And I'm going to ask you in a few minutes after Adam how that works. But what are you seeing as some of the common errors these days?
A lot of times I'm seeing where taxpayers just didn't report the losses. They didn't think they had to. And it didn't adversely affect their tax liability because they were only able to take $3,000 of their loss. But by not reporting it, for one, you didn't have the ability to claim it as a capital loss carry forward. And two, the IRS got a 1099 for your brokerage information. So they're going to be looking for that information on your tax return. So if you didn't report your losses, the transactions themselves, potentially you're going to get audited. So that's one thing. The other is a lot to do with publicly traded partnerships. And Bob mentioned this, is when you buy into these publicly traded partnership, your brokerage firm knows what you bought it for. And then when you sell it, they know what you sold it for. That's it. They're concerned about your cost basis and what you sold it for. And that's what's reported on the 1099-B. That's it. But you're getting all of these K1s that has income reported to you, and you're having to pick up this income. Well, that's additional cost basis. So when you dispose of these publicly traded partnership, if you just report what the brokerage has on the 1099, you basically have overstated your gain because your cost basis has increased for all of the income that you picked up over the years from these K1s. So you're actually paying more tax on something. You're basically paying double taxation. So be very careful with these publicly traded K1s. If you get one and you dispose of it, look on about page 12 of 13 of the big K1, and it has all these adjustments that you got to make to your cost basis. And if you don't do that, you're potentially overstating your gain for the year. So be careful of that one. I mean, there's potentially all kind of issues that we can point out, and that's one thing that we do when we take on a new client. We request at least 2 prior year tax returns, and the reason for that is, one, we need it for carryover purposes, but we want to go back and just look as part of a cursory review that we do with our clients. Do we see anything that maybe is warranted of an amended tax return? Just had a client last week that signed up with us. He said, look at my 27 return. I said, well, we're going to look at it anyway. I looked at it. He prepared it himself, and I saw that there were some things that he didn't report, just totally missed it. And I said, you know what, we can file an amended tax return, and because of that, we were getting him a refund back of $3,000. Well, that's basically going to pay for our fees and then some. So just with the fact that we saw some mistakes in the prior year return, we haven't even started his 2018 tax return, but we already see some value that we can add just with looking at the prior year returns. And that's what we try to do. We try to add value for all of our clients where we can.
Darren, with the new tax law, I was just thinking that when a client sees, if they're self-preparing, that there's no box for them to put some deduction that they're used to taking, and they would be very upset to lose, they're going to try to squeeze it into another box, like those investment expenses into the box for other itemized deductions, or they're going to try to bend the rules, or botch the QBI deduction, or all these things. Do you think that the new law is going to cause a lot of errors too?
I think it's actually potentially going to cause more errors than what we're already seeing with existing returns. I mean, for one, the 1040 has been 2 pages for years, and everybody's very familiar with that. This year being basically a little postcard and about 6 schedules later, it's just going to be confusing trying to make sure you're getting the numbers all in the proper places. And yes, if you're used to normally claiming your investment expenses and now you can't see any place to put them, trying to force it somewhere, the qualified business deduction. There's not a form for that. There is no formal form for 2018 for that. 2019, they're working on one. But just knowing how to calculate that behind the scenes, especially if maybe you're getting a K1 with something and then your spouse has a Schedule C, combining all that activity and being able to calculate that, there could be a nice deduction to take there. But knowing how to do that, it's difficult trying to do it on your own. It's 2018, if you've never used a paid tax preparer, would probably be the year that you really want to do it. Just one, to have that comfort level that you know that the return is being done by a professional. And with all the tax law changes, knowing what you can and really what you can't do, because there's been some give and there's been some take with the new tax law. So just look into that, especially as we get closer to the deadline. And if you haven't looked at your tax return already on how to prepare it, you may be in for a shock.
Darren, I've been pointing out that people should carefully enter the tax information by spouse if they're married filing joint normally. There used to be a big penalty for filing separate, but it seems that a lot of that penalty has gone away. I imagine that a lot of clients really want to know about that difference, and you need really good software and proper techniques to do that. That's another reason I imagine people want to work with our team. Adam Manning, is this a good year for traders to purchase our tax compliance service? And how does the service work? I mean, what do we do with the 2018 preparing of the returns? Federal, state, married filing joint, separate, deal with both spouses? Does it come with some 19 planning too? How does it work?
Yeah, I mean, just to reiterate what Darren said, I do think that this year is a great year if you've never used someone to have someone prepare your return that's a paid preparer that knows the tax law. There's a lot of changes that took place that you need to be on top of. As far as our services, yeah, once you sign up, we send you some organizers and we get your information gathered. Once you upload it to our share file server, which is a secure server where you upload your files, we begin working on it. We look at your prior returns, as Darren noted. Then we see what you have, and if you have outstanding questions, we email you and we address those. And once we get the return kind of done, we send you a draft review and you look over it, and that's time for you to address any questions you have on the return. And then we can finalize it. And at that point, we can, before finalizing, we can work on planning, or we can set up a time in, November or December, early December, to work on some tax planning for year-end stuff.
Great. Now, Darren, we have a new client evaluation. We used to charge for it, and now it's complimentary. It's a 15-minute session with you. I mean, I know that you wanted to see if a new client is a good fit. It's only the first year. How does it work, and what's the value of that session for the client and us, Darren?
If you're interested in becoming a client, tax preparation client of our firm, we require that you sign up for this 15 minutes. It's basically free. You just go to our website, you can sign up for it, or you can send us an email at info@greentradertax.com. Then our admin team is going to ask that you provide your 2017 tax return. And then they're going to give you a link to my calendar so that you can see what's available, what's best for your time slot and my time slot, and we book it. And then we're going to have the 15-minute call, and I'm going to ask you some various questions. One, what was your reason reaching out to us? What are your plans for 2019? And then seeing where we can add some value to what you're doing. And I'm going to be honest with you. If I see that we can add value to what you are currently doing or could do, I'll let you know that and say we can help you. If you're using an existing CPA already, and from what we talk about on the phone call, and I don't see where I can add any additional value, I'll let you know that. And the reason is I don't want a CPA coming and taking away our clients. And the same thing, I don't want to do that to a fellow colleague within the profession. So if your CPA is doing a good job, then stay with that CPA. If you're happy, you have that relationship. But if you come to us and you said, you know what, I've talked to my CPA about trader tax status and I got the deer in the headlights look, Okay, well then that's where we're going to see whether claiming trader tax status is going to be beneficial for you. And we're going to run some quick, as they say, on the back of the napkin numbers and see potentially how much savings you could get from that and whether it's worth it for you. If you've only got a couple $100s of trading related expenses, and depending on your tax bracket, maybe it's not worth filing as a trader, but maybe you need to consider electing mark to market. So it's more or less an opportunity for you to get to know us and for us to get to know you, to see whether we can be a good fit for you, because we are not looking to take on clients for basically a one and done job. We're really not. We would like to take on a client for a long-term relationship to where we can be there for you to address your tax questions as they come along. So that's really the reason for the call, because in the past we didn't have the call and someone would basically sign up for our service kind of blindly and then come to us, and then when we really get into the meat of things, we find out, you know what, you really didn't qualify for trader status, and now we've already basically got the tax return started on the return, and you probably didn't even need to leave your existing CPA. So it's more or less getting things on the right track from the very start, and that's the reason for the call.
Great, Darren. And it's an evaluation. It's not a consultation. If the client wants to see if they qualify for trader tax status or should make elections or entities, then they're back with me for a paid consultation. This is not a consultation. Once you're a tax compliance client of ours, it does come with consulting and planning, but not during this evaluation. And Darren, do you give them an idea of price too?
We do. We evaluate, and that's the reason for the 2017 return, so I can kind of see what you already have, and then we discuss what you have going forward. And the reason for that is I use the analogy of you just walked out of the grocery store with a bag of groceries, and you basically walked up to me and you said, you know, how much did I pay for these bag of groceries? Well, I don't know. I got to actually see what you got in the bag. Do you just have milk and bread, or did you go buy some filet mignons? And that's the reason for the tax return. I need to actually see what all you got going on so we can properly give you a very reasonable quote for the preparation.
Excellent. And I think it's great that we do that, Darren, to be sure that people are a good fit. I know that people really appreciate it, and they should get signed up for that soon, because I know eventually every year we get to a point where we say we can't help you until after the extension deadline, and people want our help before, so they should get motivated and move now. So let's do a little questions and answers. I know people have been asking questions all along. Darren, have you answered all of them, or are there more, any that you want to bring up and share with the others, that you can raise the question and give what your answer was?
I've been trying to address as many of them as I can. They've been kind of across the board, and some I still haven't had an opportunity to get to. But I mean, one question that has popped up a couple of times is, and I'll let either you or Adam address it, is if you have an entity and you're trading inside of an entity, and the entity has elected mark to market, but you're still investing or somewhat trading individually, how does the two correlate to each other? Are they related, or are they kind of separated?
Do you want to do that one, Adam, or do you want me to?
Yeah, I can do it. So the question was someone trading an entity and someone trading individually, or they have an investment account individually there?
Correct. Yes.
Okay.
Investment account individually, but trading inside of an entity.
Yeah, this is something we see often. This is actually a setup that we like to actually do with most of our clients if we can, is to have the entity, you know, be the trading vessel and the vehicle, and then they can keep their individual accounts as investment accounts. And oftentimes clients want to keep their individual tax return with a CPA they've used for years locally maybe, and we can do the entity tax return, provide the K1 to them, and then all the trading activity is all held in that, and the K1 passes through and can be put into the individual. So there's no issue there. You can easily have the trading in the entity and keep your individual investment accounts.
Yeah, and if there's a capital loss on, or unrealized capital loss that they're nursing as an individual, and they're hunting for capital gains, they can always have their entity retain capital gains treatment to pass through capital gains to their individual return, but they're probably better off ring fencing and doing the 475 in the entity. And it's also better for segregation of investments, because if you have an individual trading account and you're trading Apple, Apple options, but you're holding Apple stock as an investment in your segregated investment account, the IRS can play havoc on you, kicking a loss out of the trading with 475 that you've elected, while grabbing at the investment account capital gains so you don't get deferral. So we like to ring fence your trading in an entity. It's one of the benefits of the entity. I'm glad you pointed that out, Adam. That was a good one, Darren. Any other ones that would be good for everyone to hear about?
Well, what is an advantage overall to trading inside of an entity as opposed to just trading as an individual? Why would I consider setting up an entity, or the pros and cons to it?
Well, the entity looks better than the Schedule C red flag factor. The entity gives you the flexibility of electing 475 later in the year. It's better for ring fencing with 475 versus your individual accounts. If you want the health insurance and the retirement plan deduction, you have to have the S Corp. So like an LLC with the S Corp election. If you want to look better than the Schedule C and you're married, perhaps the partnership return can be better. That's really the main benefits. And like in anything, you come over to our website. Let's bring that up. And you go down to the tax center and click on Entity Solutions. And it will explain what the benefits of the entity are right there. Solidifies trader tax status, unlocks employee benefits for health insurance, gains flexibility of 475, limits WARSO, all the things I just said. You go to the tax center, you make it bigger. You drop down, you find the area that you want more information on. We talked about trader tax status, tax treatment on financial products, WARSO losses. You go to the tax center, learn more. It's excerpts from the Green's 2019 Trader Tax Guide. Pick up a copy of that. So you want tax compliance, come over there, read about that, scroll down and say, okay, I want the new client evaluation. Sign up for the new client evaluation, no dollars. Get working with Darren on that. What's another good question, Darren?
Probably the last question I'll leave you with is, and I had this asked a couple times, is what are we doing, or what do we plan on doing in regards to the proposed financial tax that some members of Congress are proposing?
Well, we have covered the financial transactions tax, the original name, for over a decade when it was originally floated years ago. We were, as a firm, one of the major writers about it, as an advocate for traders, very against it. We have a lot of white papers about it. They may not be on the site anymore because we take off very old content. We're going to replenish it. I did have a tweet about it. So if you went to my Twitter account, you'll see that I had a tweet about it with a picture of Cortez floating the tax. I mean, there is a new bill. The Democrats is going to get co-sponsors. In Bernie Sanders' town hall, he said to pay for Medicare for all, they're going to raise taxes on billionaires and the upper 1%. Well, a lot of traders are not billionaires in the upper 1%. And he said to pay for public colleges and universities, he's going to use a financial transactions tax. And my point is that if you really want to go after billionaires and the upper 1%, it's not with a financial transactions tax, because they don't trade. They don't turn over stuff. They do buy and hold. They never sell. Steve Jobs never sold a share of Apple stock. They play a game of long-term capital gains and deferral. And if you really want to go after the super rich, maybe have a higher capital gains rate for a very high level of income. Why tax Main Street traders, our clientele, who are not billionaires that I know of, and it's misplaced. Now, on the other hand, as I pointed out to you the other day, Darren, and this is going to be something I give attention to and I'll start writing about. You know, it reminds me of the gas tax. If gasoline drops a lot, they love to then add a tax to it to take the space, to fill the space for the price drop so that the government can get money for the roads or whatever. I don't want them thinking that commissions, I mean, when I came into the field as an accountant, it was just after they got rid of fixed commissions. It was a sleepy business, Wall Street. And they think about how commissions have been lowered. Since we started with green trader tax in 1997, think of what commissions, I mean, I remember Schwab was $29.95. Now it's what, $4.95 IB. I mean, Lightspeed's commissions are super, super low. Look at Lightspeed's commission structure. So people are going to say, well, the commissions have gone down so much that we can have some SEC fees. We can have a financial transactions tax. If you could make money 5 years ago, why can't you make money now? So there's going to be the pressure of that argument as well. So I am going to attend to it. I'm going to have a lot of arguments while I think it's never worked where it tried. But let's save that for another webinar on another day. So everybody, that's all you got, Darren? Good. So everybody come over to contact us. Send us an email. Give us a call. See how we can help you. I want to thank my partners, Darren Neuschwander and Anna Manning. They do a great job in the tax compliance section of our company. That is our core business. It's super organized, all the best practices. Read about our virtual process that we have on the website. Under About Us, go to see our professionals. And Rob Lifson of Lightspeed, thank you very much for this opportunity again this year, and I'm passing back to you.
Great. Thank you guys so much. That was very valuable information. We're so happy you took the time and extended your time here with us. And guys, I hope you got a lot out of this. I see Darren was answering questions left and right, so you really had a full consultation with a great tax team right here with this webinar. And certainly please reach out to the Green Trader Tax team for their consultant and personal services, because they are the best in the business. So guys, we hope to have you back again. Thank you so much. And everyone else, thank you for joining us. And certainly this is going to be on our website within a few days to review, and certainly to look at again. So everyone, thank you. And Adam, Darren, Robert, thank you guys so much. Have a great night. Thank you very much.